Thank God it's Friday. Good morning, everyone. Welcome to 55 minutes of current and relevant business conversations here on Business Morning. I'm Ini John Mekwa, and as usual, we'll start with what's going on in the global oil space. We see the prices rose today after the U.S. said that its naval blockade of Iranian ports could continue indefinitely, and that has reignited concerns over energy flows through the critical Strait of Hormuz. Friday's upward moves follows U.S. Treasury Secretary Scott Bessent's warnings in an interview with some reporters. Says that measures are aimed at the economic isolation of Iran, which have never been seen. And Bessent's comments comes after U.S. Defense Secretary Pete Hegseth told reporters that U.S. forces could maintain an indefinite blockade of Iranian ports. And the warnings come after the United Arab Emirates on Thursday said that Iran attacked two vessels from the state-owned Abu Dhabi National Oil Company, which were transiting the strait. And so we see huge surge on the price of both Brent and WTI, 1.15% up for Brent at $88 there, and then WTI also 1.24% increased to $82.02 or 20 cents about that. So the war continues, whether it's by strikes or by words, and of course, every part of the world feels the impact. And here in Nigeria, daily petrol consumption is down 1.27% year on year to 47.4 million liters in June 2026 from 48 million liters that was recorded in June 2025. This is according to data from the Nigerian Midstream and Downstream Petroleum Regulatory Authority, the NMDPRA. The decline represents about 600,000 liters less petrol consumed every day, reflecting continued changes in fuel demand following the sharp increase in petrol prices since the removal of petrol subsidy. NMDPRA data also shows that petrol consumption fluctuates during the first half of 2026, falling from 60.2 million liters per day in January to 46.3 million liters in May, before edging up to 47.4 million liters in June. Meanwhile, local refineries supplied 77.9% of the 8.48 billion liters of petrol supplied to the domestic market between January and June, while imports account for the remaining 22.1%. Let's see how the market closed yesterday. We saw that the oil share closed in the negative again yesterday, 0.23%. There were some bulk transactions that happened in the market yesterday and drove these negative sentiments down home. And the oil share closed at 157.880 trillion naira. Activity was mostly green. That's compared to the previous day. Volume was at 4.24 billion. And value at 50.65 billion naira, and deals 41,277. Top gainers yesterday, Intelligence, John Holt, and Transnational Express all gained almost 10% each, while the flip side had Unilever, Cheloram, and NIDF. They shared about 10% each also. Top trades, Cornerstone, VFD Group, and Charms, they topped trade yesterday. The National Insurance Commission, NICOM, has cleared 7 additional insurance companies after verifying that they meet the new minimum capital requirement under the Nigerian Insurance Industry Reform Act, that's NIRA 2025. The latest approvals bring the number of verified and compliant operators to 50, comprising 48 insurance companies and 2 reinsurance firms, effectively concluding the industry's recapitalization exercise. And the newly cleared firms are Empol General Insurance, Empol Life Assurance, Sovereign Trust Insurance, Tangerine Life Insurance, Alliance and General Insurance, Guinea Insurance, and Regency Alliance Insurance. NICOM's latest actions follow a final verification process for companies that had submitted their recapitalization funds and documents for regulatory review. The exercise is aimed at strengthening the financial capacity, resilience, and competitiveness of Nigeria's insurance industry. And the federal government has unveiled a new taxpayer protection charter that's aimed at strengthening the rights of taxpayers, improving transparency, and promoting greater confidence in Nigeria's tax administration system. The Chief Executive and Tax Ombud Office of the Tax Ombud, Mr. John Waboeze, disclosed this during a stakeholders meeting in Abuja. The initiative is expected to provide clearer guidelines on taxpayers' rights and obligations while promoting fair, efficient, and accountable engagement between taxpayers and revenue authorities. China has approved a 200 million yuan grant to Nigeria to support development projects, strengthening bilateral economic cooperation between the two countries. The disclosure, which was made during a meeting between the Chinese ambassador to Nigeria and the permanent secretary of the Ministry of Foreign Affairs, shows that the grant, worth approximately 40.32 billion naira, is based on the Central Bank of Nigeria's exchange rate, is intended to support Nigeria's national development and economic growth, and also deepen Nigeria-China collaboration. All right, so we want to look at the reality of Nigeria's macro disparity, and we'll take just a short break now, and then we'll head into the studio for that. Welcome back. It's Business Morning here on Channels Television. A lot has been said about the disparity between Nigeria's macro and microeconomic situation, and while the government is very happy with the status of the macroeconomy, well, a lot seems to be yet to be done when it comes to micro, and so we ask, what's the missing link once again? But let's look at the picture of both Nigeria's macro and micro at this time. So we start with the GDP. We saw that the GDP for the first quarter of 2026 at 3.89% year on year. And yet, in spite of this big growth, a lot of people would describe it, SMEs continue to face high operating costs and financing constraints. So then what's the essence of the growth? Headline inflation, well, that has remained elevated, so it's not even good even from the macro part. And of course, that translates to more expensive food, transport, housing, and energy. And of course, more threats to the purchasing power of businesses and households. Monetary policy remains restrictive. As we know, interest rate is still very high. Cost of fund is high and businesses are feeling its high borrowing cost, making credit expensive. And further, we see improved naira stability. We've seen, at least in the official market, we've seen the naira below 1,400 for many months now, and yet imported inputs remain vulnerable to exchange rate movements. That's the reality. Oil production is still the major contributor to government revenue, and yet fuel is still very expensive. We have higher, yesterday was celebrating higher production of crude by Nigeria, but of course we now pay even more for petrol, even though we've seen a little bit of reduction in between. Cost of logistics is still very high. Input costs is affecting operating margins as expected. Reforms are improving some macro imbalances, but the same reforms seem to be creating substantial adjustment costs to households. The NGX, the local boss, has been doing well, even though we see seasons of pullback, which is a natural thing for any progressive market. Capital inflow shows that investors are more confident about Nigeria, but many Nigerians are not directly benefiting from this increase in financial asset prices. There's improved FX availability. Reserves, we've seen our reserve hit $50 billion, and yet access to affordable credit is still far away from the average Nigerian. Perhaps we need to look for the missing link. The Director of Qatar's Economics, Mr. David Adeoye, is in the studio to help us link the micro and macro. Mr. Adeoye, good to have you in the studio. What are we missing? Or is it just a natural thing? You know, they say in every policy there's the lag.
Yeah.
Is it the lag? Should we not be in a hurry?
There is the lag. But it's also important that we understand the context of where we were coming from, what has happened, and what lies ahead of us. On matters like this, I like to use a metaphor of a patient who had to undergo a surgery. You know that, one, if you don't like to see blood, you cannot be a surgeon. That's number one. Number two is the surgeon also needs a mix of courage and precision to act. So the surgeon takes the patient, in this case the Nigerian economy, into the theater, surrounded by...
In this case, the surgeon is President Tinubu.
Yes. The buck stops at his table.
Yes, it does.
Yes. So the surgeon goes in for the surgery. The focus of the surgeon is not always on the moment, on the comfort of the patient during the operating session. The focus of the surgeon, first, survival, the patient must survive. Two, the patient must have a very strong prospect of quick recovery. And you find that there is what we call post-surgery care. So all of that has to happen. Now coming to the matter, so we need to understand where was this patient before the surgery became necessary. Is the surgeon to blame for the pains, or did the patient have debilitating conditions that simply have to be corrected? In that case, a so-called merciful or compassionate surgeon may not get that job done. Now, when you see a surgeon come out of the theater and you see sigh of relief on his face, he's not saying the patient is already comfortable, but he can see the future of that patient, that the biggest threat has been removed. And now the patient can start a journey of recovery. So I start with that metaphor. That was what Nigeria went through because we've had distortions around this economy for too long. And when we look at the way our population was growing, we know that there are issues that we simply have to address. Population was growing at multiple of production growth. That was a problem. It's just like saying the population of a community keeps growing while the harvest from their farms remains stagnant. Poverty was going to increase, with or without a corrective surgery. But if that poverty is going to slow down at certain points, there must first be a corrective surgery. Why are people not going to the farms? Why is production not rising? So all of those were addressed. And if I can refer to the data, I look at different data sets between May 2023 and mid-2026. Headline inflation was 22.2 in 2023 May. Today is 15.9%. In fact, it actually at some point peaked at 34.8% inflation. That was bad news for any economy. Now, external reserves as at that time was $3.9 billion. Today is $51.9 billion. Our balance of payment was in the negative, 3.34 billion dollars. Today is in the positive, $2.38 billion. Our exchange rate, yes. In fact, the problem with the exchange rate at that time was not even the level. Was one, the multiple windows, and two, the range between the official and the parallel market. And we had exchange rate between 463 naira on the official market to $1 and 700 naira in the parallel market. That was killing. Which investor wants to come in? And without investment, we can't grow production. Without production growth, we cannot provide jobs. Without jobs, we cannot reduce poverty. Now, when we look at those factors, was today we have exchange rates at between 1,360 and 1,400. The difference is just 40 naira, and we have a single market, as it were. When we look at our debt to GDP ratio, it was 38% in 2023.
So it was a much needed surgery.
It was a much needed surgery.
So surgery is over. Where are we now?
Excellent question. Excellent question. So surgery is over. Now, at the end of the surgery, after post-surgery, some things need to happen. There is the responsibility of the medical team. There is the responsibility of the patient.
So first of all, this is post-surgery.
Yeah, post-surgery, 3 years post-surgery.
So the difference between the micro, or the disparity between the micro and macro, is part of the discomfort that comes with the surgery, right?
Well, partly because some things will take time to recover.
So that's the pain now. That's the pain.
Yes, so part of it is pains, but those pains will not last forever.
Okay.
So it's also good for us to check, to ask certain questions. What has improved? So yes, the headline.
I noted those things that have improved.
Exactly. So you have the headline numbers.
But
look like macro.
But yeah, because the average Nigerian doesn't feel this.
Well, I think that's something we need to look at closely.
Okay.
And ask ourselves, which part does the average Nigerian feel, and which part is yet to be felt, and why? Because at each point in time, even doctors, after a surgery, they examine the patient, what is meant to be improving that has not improved, what is taking longer to show up. So for example, when we look at jobs or prosperity, we know that we all face this cost of living crisis. But when you look at the income or earnings of companies, it has gone up. One thing most people will not tell you, even your neighbors, some of your friends, nobody picks a trumpet to say, my salary has increased by 25%.
But operating cost has also gone up.
Yes, operating cost, revenues went up, operating cost went up, but earnings, the difference between the revenues and the cost has also gone up. So the margin for a number of companies have expanded, and that's always good news. Investors want revenue growth, and they also want positive margins on that growth. So I will say yes, we've had that, but it's also good for us to look at a few items. So let's ask ourselves this: what is the distribution of participation in productive activity? And productive activity, I'm not just loosely saying hard work or work. How productive are we as an economy? Now, an economy that has been subsidized for at least 4 to 5 decades is not going to suddenly change its dynamics. For example, we keep finding, there is a lot of evidence that the public sector in a number of places is bloated at different levels, that you have more people than you need. The truth is, if you must cut down, that increases the pains. But with the size of people you may have on the payroll, there's a limit on how much you can pay. But it still comes down to productivity. How productive is the economy? Now, we've had an economy where services account for more than half of our GDP at certain points in time. And we should be asking, so where is the consumption coming from? Domestic production imports. So to the extent that we still import a lot of what we consume, we have problems there. So until production rises, and let me quickly reference a particular point. Now, talking of time lag, interest rate and prices, we usually take 6 to 18 months to adjust.
So is that the lag?
Yes, that's the expected lag.
Okay.
But let's not forget that when it comes to prices, the global economy had a shock earlier this year.
Still has a shock.
Yes, we are still in that shock. Exactly. So the US-Israel-Iran conflict is what pushed up inflation back. Otherwise, Nigeria's inflation was under control. Now, from exchange rate to investment decision takes 12 to 36 months on a good day, and we are seeing that. So investments are coming back. Let me just use a single.
Give us the time lag for the macro translation.
That's what
we really want.
So I'm going to show you that.
Okay, because there are conversation as to, is it leakages in the public sector especially that's causing the increased disparity, or is it the intervention programs, that the social interventions program that we see the government being more intentional about now?
Yeah.
Is that what is going to fix this gap?
No. What's going to fix the gap is production. And there is a clear link. So we start from reforms, we move to a place where the currency is stable and investments begin to come in. Now it's an 8-step process. You get to a point where capital begins to flow into the economy. That capital must find its way into factories, into farms, into different productive activities. It's after that we can begin to see the effects, or the expanded effects or elevated effects on household income.
So do you see us on that path?
We are on that.
What are the signs?
We are at the point where capital inflows has increased. That's always a good one. When capital inflows into an economy rises, first you see construction starting. Construction, and I'm not just talking of government mega projects, which will have its own spillover effect, positive, but we also have a case where factories start getting constructed. Post-construction, that factories start operations. Private sector, yes. And one mistake we shouldn't make is expecting that Nigeria is still a welfare state. No. That has effectively ended. Yet the government is putting...
Is it the removal of subsidy that ended that?
Yes, removal of the distortion.
We still have electricity subsidy.
Subsidy, but if you look at it, the electricity sector is also still not performing as it ought to. So when I say Nigeria is no longer a welfare state, the question is, were we even adequately resourced to be a welfare state? We operated as a welfare state on loans, as it were. Our welfare tendencies, or our welfare programs, as it were, the FX subsidy, the petroleum subsidy, and so on, was funded by debt. And some of that debt, we are still paying it, we are still servicing them till today. And because now, were those even productive debt? No. And when you check what has happened to Nigeria's debt to GDP ratio over the past 13, 14 years, you find something striking. Compared to other countries, our debt has risen much faster than our GDP, meaning that our debt was less productive. And how productive can the debt be when it was funding welfare, as it were? Now the welfare is even a format that benefited the rich more than the poor.
So you say, I guess in conclusion, we're on the path to production.
We're on the path to production, and
we don't know the exact time lag that we should expect moving the macro benefits to the micro.
Let me say, we have a good part of the micro benefit already manifesting.
Yeah,
For example, anyone who has an RSA, a retirement savings account, you will have noticed some growth in your PFA, in your RSA account balances in the past 3 years. The money has been, the value of the funds has been jumping. Why? Because the equity market is growing up. So any Nigerian who has a pension fund is already benefiting at that level. Another area is state governments are no longer owing salaries like they used to. Yes.
Because I wanted to say,
you know what
they're still owing.
No, they are no longer owing.
Like they used to.
No, they are not
Or
owing
it's
at all.
totally
State governments are no longer owing salaries.
Oh, wow.
Because they have the revenues. So instead of sharing the revenue in the form of PMS subsidies, FX subsidies,
yeah, we know FAC has increased.
Yes, FAC has increased. For some states, it has quadrupled. So now this is it. When government owes salaries, what happens at different levels, local, state or federal? Demand in the market is weak. The market women suffer. Because then what does that mean for factories? Production slows down because there is higher inventory. Nobody is buying what you have produced. So there is strong spillover effect of that. We also don't have fuel queues anymore like we used to. Then when you look at ASU strike, the universities have been running smooth. In fact, in the past 3 years, we've had 0 days of ASU strike. That's unprecedented in perhaps 4 decades.
So we are on our way?
Yes, we are on our way, but we can't expect that trickle down will happen simply from government revenue down to the household, except for the most vulnerable households, for whom government has a welfare intervention program. Outside of that, production must grow, and people will prosper to the extent that they are involved or they participate in productive activity, either as investors or as workers or as a member of the value chain.
Well, be part of the productive.
They have to be part of it.
All right, thank you so much for coming on, Mr. David Adeoye, the Director of Quarters Economics. Thank you for sharing that picture with us.
Thank you.
All right, so we head straight to Abuja studio where we have the National Coordinator of Nigeria AFCFTA Coordination Office. She's also the Special Advisor, Legal Affairs on Trade and Investment to the Minister of Industry, Trade and Investment. Joining us to discuss AFCFTA is Ms. Patience Okala. Ms. Okala, good morning. Welcome to the program.
Thank you very much for having me.
Yeah, so we hear there's the Africa Digital Access and Public Infrastructure for Trade, ADAPT. That's a flagship continental initiative of the AFCFTA Secretariat and is designed to support the implementation of the protocol on digital trade by connecting Africa's trade ecosystem, digital identity, customs, payment, logistics, and all of that. And we've been hearing a whole lot about AFCFTA. In fact, I attended one of the events where the minister, Minister of Trade, some small businesses were given licenses to start exporting to Rwanda and other countries. So I must say that it seems a lot of activity is going on there. But tell us about what difference this digital system will bring to the AFCFTA implementation.
So first, thank you very much for having me. Let me just start by giving a background to what the AFCFTA means for Nigeria and for Africa in general. The AFCFTA holds a lot of promise for the economic development of Africa. We're talking about a population of about 1.4 billion people, that with a GDP of 3.4 trillion in terms of dollars. So the AFCFTA, the objective of the AFCFTA is to transform the African continent into one continental single market, so that you export and you do your businesses between Nigeria and Burundi as easily as you would do it between Lagos and Kano. So that is the prospect that the AFCFTA brings, and it does this using 2 critical pillars. The first of which is the zero tariffs that comes under the preferential regime of the AFCFTA, and then the second is the promotion of value addition and beneficiation of our local products in the continent to help with industrialization, so that Africa and Nigeria in particular moves away from the export of raw materials to actually adding value to those products and creating jobs for our teeming youth. Now the AFCFTA framework agreement has 8 protocols that are enablers to the implementation of this agreement. And the protocols are the protocol on trading goods. That is, I believe, the most popular because it talks about export of physical goods. And then we have the protocol on trading services, the protocol on dispute settlement, the protocol on investment, the protocol on digital trade, the protocol on women and youth in trade, the protocol on intellectual property rights and finally the protocol on competition policy. The ADAPT initiative that you had mentioned speaks specifically to the protocol on digital trade. And let me start by saying that Nigeria is the co-champion of digital trade. We were so designated by the African Union Summit of Heads of State and Government, the 37th ordinary session last year in 2025. Now, carrying that title as digital trade champion is not just a position for us in Nigeria, given that Nigeria has comparative advantage in scaling digital trade across the continent. There are 9 unicorns in the African continent. 5 of them are Nigerian. So Nigeria is a natural leader when it comes to digital trade. Upon the designation of Nigeria as the digital trade champion, of course, that is President Bola Ahmed Tinubu, GCFR himself, and then the Honorable Minister, Dr. Jumoke Oduwole, is championing that cause on his behalf. Now, with that designation, it became important for us to go beyond just bearing that title, but to ensure that the benefits of the digital trade protocol, an innovative, one-of-its-kind protocol, actually accrues to the Nigerian digital trade operators first. So what we did was in April last year, we undertook a digital trade survey just to feel the pulse of the private sector and find out where they want to expand their businesses, where they would like to penetrate on the African continent. And they came up with 5 main countries that they wanted to expand their businesses and their operations into. They came up with Kenya, Rwanda, South Africa, Ghana, and Egypt. So what did we do? We called the digital trade regulators from those 5 countries, got them sitting together in a room in Lagos for them to handhold our own digital trade regulators from this side and take them through the process of penetrating their markets. What do they need to understand? How can they guide our businesses? So that was on day 1. And then on day 2, we had them engage directly with the digital trade private sector operators in Lagos. And that conversation is still ongoing. Now, what ADAPT is doing is creating a platform to enable the operationalization of this digital trade protocol. So from digital identities, from having the trust frameworks, from interoperability of our digital trade frameworks. Because you see, like you know, digital trade is an end-to-end transaction. We cannot just have digital trade in Nigeria functional and then things that were done. No, for AFCFTA is to enable the trade from Nigeria across the African continent. So what Tony Blair Institute has done with the AFCFTA Secretariat, and then of course Nigeria with the NAC office chairing that project, is to start a sandbox. So we have Nigeria, we have Kenya, and we have Morocco as the 3 pilot countries for ADAPT. What it seeks to do is to first of all undertake a gap analysis and find out where are we in terms of regulations. What do we need to block in our regulatory gaps to enable us fully operationalize the digital trade protocol. So that conversation and that process is underway, both for Nigeria and the other 2 pilot countries. The next step will be to have those sandbox trials and see that the interoperability, making sure that we can send digital prepayments and even e-documentation for our transactions at the ports is done. So that is what ADAPT seems to do.
All right, Mr. Kala,
is to help with the implementation.
So who are your targets? What are the requirements? Just let us have a picture of those who can participate, who are supposed to participate. What do they need to have or know before they can get on ADAPT?
Okay, that's a good question. So for now, the target are the policymakers. Because like I mentioned to you, where the first step is to have a gap analysis of the regulations and see where the gaps are and ensure that we have regulatory framework that can enable that trade. It's one thing to have a beautiful document, it's another thing to operationalize it. So this is a test run, basically. So the target now, we're having NITDA, we're having NIMC, we're having the Digital Protection Agency, we're having CBN, we're having them come together to look through the regulatory scope and see what we need to put together to ensure that the private sector can scale. And in addition, we have the private sector, we have NASIMA, we have the women groups as well, as part of the conversation. But where we are right now is at the policy stage to ensure that we have the policy that can support the scaling that we anticipate under the digital trade protocol.
All right. Well, I hope that when that policy is structured out, that perhaps you would come back on the program so we would share that with those who are directly affected, and then we can get more participation on the AFCFTA. As you said, of course, the potential on that platform is huge, and Africa needs to use it. But for this time, we need to say thank you so much, Ms. Patience Okala, the National Coordinator of Nigeria at AFCFTA Coordination Office, and also the Special Advisor, Legal Affairs on Trade and Investment to the Minister of Industry, Trade and Investment. Thank you for your time. I will hope to get you back on the program soon.
We'll be delighted to be here. Thank you.
Now, we know that the recap seems done and settled. What is the dust settled? Yes, we don't know. Well, Augusto and Co., they decided to capture the banking industry. Recently, a couple of weeks ago, the rumor that the bank was folding up in Nigeria affected the stocks and investors' confidence. And I said, well, I don't think an existing bank that has the backing of the NDIC and the CBN can easily fold up in Nigeria at this time. I believe we have gotten to that stage. But anyways, let's look through the lens of Augusto and Co. We're sharing their Nigerian banking industry report for 2026. And some of their findings is this. They said in the financial year ended 31st December 2025, the industry was shaped by recapitalization and the termination of regulatory forbearance. Remember those two factors? They were very active conversations in the industry. Forbearance termination induced a 2.9 trillion naira write-off, representing 63% of the 4.6 trillion additional capital injected. And then at the end of the recap, we saw 4.6 trillion naira fresh equity into the market, into the industry, the banking industry, and 73% of that was sourced by domestic investors. Isn't that a good thing? Shareholders' funds we saw expanded by 31.2%. Capital adequacy ratio, that strengthened to 25.5%. Full year 2024, it was 18.1%. So it went up to 25.5% year on year, and then 12.7% year on year increase in total assets and contingents in the sector. However, Augusto has some concerns. The first is potential capital shortfall of 486.7 billion naira at the holding company level, and we know that it's still unfinished conversation around the holding company, the holdcos. CBN has started that conversation. Another concern of Augusto is the forbearance write-off where necessary. They believe that there's a probability that it has masked the true extent of deterioration in the loan book, and of course we know that's a threat to the industry. Impaired oil and gas credit exposures accounted for 62.2% of stage 3 loans. That's up from 32.2 in the prior year. Let's face these concerns now with the head of financial institutions ratings at Augusto and Co. Mr. Ayokunle Olubumi joins us virtually from Lagos. Mr. Olubumi, good morning. Welcome to the program. Let's just go straight. We don't have a lot of time, unfortunately. Let's just go straight to the concerns of Augusto, beginning with the whole core. We know that the CBN, I think it's an unfinished, we don't have a definite stance yet when it comes to the whole core, but we saw some conversations and responses from the CBN and stakeholders. What's the situation now? What are your fears concerning the whole core companies?
Okay, good morning. Thank you for having me. And like you mentioned, the discussion about the old co-regulation is still ongoing. I think the directive is not too clear. For instance, the way it's worded, it won't affect only the holding company, but it will also affect the banks with international banking license. So if you look at it, we have about 7 holding companies, right? And then we also have another about 3 or 4. If you had, in addition to those holding companies, we have some other banks that also have international banking license. And also the concern also is that we've just concluded the capital raising exercise. you realize that it's going to be challenging for the old co to even go to the investors again and even ask them for additional capital. It gives also concern about capital planning. When do you even expect to have additional capital? But like you mentioned, it's still ongoing. The CBN is still engaging with the stakeholders, and then we expect that before the end of the year we'll have a landing about this regulation. Having said that, based on the prudential the guideline that we have available, right? Currently, just about 500 billion additional capital will be needed by the opening companies for them to comply with regulation the way it's stated currently.
And then you also are worried about the true extent of deterioration in the loan book when we look at the forbearance write-offs.
Yeah, I think the forbearance write-off, it's help us to even see, because if you look at what has happened over the years, we've had some loans that are not performing, but we've been using the forbearance to actually even max it. So what we are gradually saying now, we are removing the layer and trying to see the true state of the loan book. What I'm saying is just we are actually moving towards the cleanup of the industry or the industry loan book, right? With the write-off that we had, right? Because if we've not had that write-off last year, the industry, the impaired loans will have actually been up to 11%, right? After removing the forbearance, if you've not had the write-up, but the write-up of 2.9 trillion moderated the impaired loan ratio to 6.5% that we had last year.
And oil and gas, you think, is the most exposed, accounted for 62.2% of stage 3 loans, and that's higher than the prior year.
Yes, because if you look at the bulk of the forbearance loan, over 80% of them are in the oil and gas sector. So expectedly, when the forbearance was removed, you see that the bulk of the exposures that are affected are actually the oil and gas. And if you notice that the downgrade that we had last year, the bulk of it are actually the oil and gas. So the oil and gas sector has actually been a blessing, or has also been a concern to the industry, because on the one hand, if you look at the size of the loan book, it accounted for about 30% of the loan book, and in terms of the impaired loan, it's just about 62%, which is very, very significant.
So when we put these concerns that you have shared in your report, does it present any real threats to the banking industry in Nigeria?
I would think that the industry is in a better state. What we've been doing over the last 2 years is to try and clean up the industry. And what the CBN first did was ensure the bank risk capital, such that any cleanup that you are doing, you have adequate buffer to support you to be able to do the cleanup effectively and also grow your loan book, grow your industry. So what we've been doing gradually, we've removed forbearance. Now the CBN is coming out with directive to ensure that the risk management structure is strengthened, such that we don't filter the capital that we've actually raised. So what we are doing now is a gradual cleanup of some things that we've been maxing and keeping under the carpet over the last few years. So I think the industry is in a better state, and things are gradually even getting better in the industry.
Yeah, so from an informed perspective now, when you hear, like, I don't know if you heard that rumor of a bank is folding up and what's your reaction, or what can you tell Nigerians when we hear such story? What are the possibilities of a bank that has gone through these processes or still going through, like in the case of the HoldCo, or such a bank just folding up?
I think that rumor was, I think it's some people that are just being mischievous, because for a bank to even fold up, the signs will actually even be there. Right, it's not something that happened overnight. For instance, the bank that the CBN withdrew the license over, I think about 3 years ago, it was clear to everybody that this bank is going through troubled waters. So the bank that the rumor was circulating, it's a relatively strong bank. It's not one that will quickly just go under. Like you mentioned, the banks just raise capital. So it's just some people being mischievous. And I think also maybe we also need to make an example of some people that are causing a lot of unnecessary panic in the industry.
Yeah, well, I hope we can do that. But thank you so much for clarifying that for us. Head of Financial Institutions Ratings at Augusto & Co., Mr. Ayokunle Olubumi.
Thank you for having me.
It's now time to go global. I want to start from the United States, where our correspondent in Washington, Maria Bird, put together a report from yesterday's trading in the markets.
Good morning, Emmy. Thursday was a great day for the U.S. stock market as the S&P 500 had a record-setting day. The S&P 500 was up at 0.6%, and the Dow Jones was also up at 0.1%, while the heavy tech Nasdaq led the day up at 0.8%. Many investors were glad to see these positive signs, as there might not be September interest rate hikes as once was speculated, as there appears to be a cooling in the U.S. inflation rate. These are all positive indicators that shows that the U.S. economy could be making a rebound.
Well, a rebound in the U.S. economy, I guess, will spill over to other parts of the world, Nigeria included, so we look forward to that. Thank you so much, Maria. And then to other stories, supertankers are going dark for longer to get oil through the Strait of Hormuz and the Bab el-Mandeb Strait, doubling down on tactics honed in the earlier days of the war in Iran. And vessels carrying non-Iranian crude started turning off their transponders to avoid detection in the weeks following the start of the conflict in late February. At the time, they would typically go dark for just a few hours while transiting Hormuz, and it seems that's coming back. Indian state-owned refiners are rushing to procure spot crude unusually far in advance as Ukrainian attacks on Russian energy assets and a stalemate over the Strait of Hormuz make supplies increasingly uncertain. Processors, including Indian Oil Corporation and Hindustan Petroleum Corporation, have already tied up some supplies until October and are now seeking cargoes for as far ahead as November. This is according to traders in that area. And these companies are buying spot supplies just a month or two in advance, even before now. Still around India, our labor force is unlikely to face widespread job losses from artificial intelligence in India, though some positions in the services sector could be affected. This is according to Goldman Sachs Group Chief India Economist Santanu Sekputa. The impact will be limited compared to many other countries, according to him. He shared this in an interview, saying that the main reason is because the workforce is pretty large and a lot of them are in more mechanical or physical kind of tasks compared to artificial intelligence. In the UK, a go-to trade in the UK gilts market suggests investors are confident that Prime Minister Andy Burnham will stick to his pledge to keep government borrowing in check. With less than 3 months before his government's debut budget, asset swap spreads, a widely watched gauge of angst and bond supply, are holding steady. And that shows that investors are positioning for Burnham to keep his word, according to JP Morgan, which is one of the biggest market makers for UK rates. And then the yen strengthened amid growing speculation that the Bank of Japan may raise interest rates in the coming months. The Japanese currency gained as much as 0.2% to 159.15 per greenback on Friday, pulling away from the 160 mark being watched by traders for the risk that government will intervene to support the yen. And Swiss growth momentum surged to the fastest pace since 2021, highlighting the economy's resilience to higher energy costs and lingering trade uncertainty. Gross domestic product adjusted for large sports events rose 1.5% in the second quarter from the previous 3 months. This is according to flash estimates, and that's much higher than expected by analysts, which predicted expansion would slow to 0.3% from 0.4% at the start of the year. Many more whistleblowers have come forward with reports of misconduct at KPMG Australia, a parliamentary committee probing alleged client data leaks at the firm heard on this today, raising concerns about a broader pattern of wrongdoing. The scandal erupted in March following allegations made by an anonymous whistleblower that KPMG misused confidential client information to bid for audit contracts. Well, KPMG initially said the claims were unsubstantiated, but the firm's CEO, audit boss, and chairman have all resigned since then, and it's been confirmed that the misuse of internal documents by staff. At a parliamentary hearing in Canberra, Deborah O'Neill, a Labour Party senator who chairs the committee, said more people were now reporting similar conduct. And Apple Incorporated has trained a large language model specifically for the Chinese market with support from Alibaba. This has been reported today, marking a shift from the iPhone maker's earlier reliance on domestic third-party AI models in China. The move could give Apple greater control over its AI offerings in China as it prepares to roll out Apple Intelligence in the country while helping it navigate strict local regulations and growing competition from Chinese smartphone makers such as Huawei. And those are the global stories for now. All right, just before we go, let's see what the markets is looking like at this time, especially beginning with the NGX. It's still a negative trade there, sustaining the negative close from yesterday, 0.16%. And then we see gold is also down, Bitcoin down. It's a red Friday for these markets. Let's hope that by intraday, when I'll be back for Business Incorporated, the color or the tide would have changed. We'll see that in a couple of hours. That's it for Business Morning today. Thank you so much for being a part of this 55 minutes journey. I'll be back at 1:30 to give you updates from the world of business. I'm John Mekwa. See you then.